Good morning, ladies and gentlemen. Let's go ahead and get airborne 0900 on these once United States East Coast. Welcome aboard. Good morning, good afternoon, good evening. Had somebody grab a max slot last night from Singapore, so welcome aboard. And we had somebody I think from Oman. So welcome aboard, literally everybody from around the world. Had a great time last night. If you did get a chance to join us our last night for Doug Robertson's vertical spread training, it is posted on the replay page, and I'll show you where that is. And obviously, let me go back a couple slots here. We're about halfway. I know the support line was ringing this morning, so we're about halfway through our 50 full throttle slots. We only open 50 of these, folks, remember, and we only do this a couple times a year because, as we've talked about throughout the week, we just really can't. It sucks having a zoo, thousands of traders and not being able to answer everybody's questions. So Top Gun Options, we'd like to keep it a nice, tight, small, close-knit squadron, and we're looking for 50 motivated folks. And there's let me show you the page again. This is let me get rid of my political stuff, making me sick. Everybody see that the SEC was hacked too? There you go. There's just a little front page of the Wall Street Journal. The SEC says its corporate filing system was hacked in 2016, and Equifax hackers roamed its system undetected for months. Awesome. So there you go. One of the credit agencies that slams you and puts you into the dirt. Hackers have all your information, so that should make everybody feel good. But here's the replay page. go.topgunoptions.com/replay. I know there was a lot of support tickets about, hey, I want to grab a slot, but I need to watch the replay or replays. There they are. And then obviously we covered this yesterday. Here's the different tracks here at Top Gun Options. We have the defensive annual track. We'll have a special announcement tomorrow. Make sure you don't miss the flight schedule or our final event tomorrow at 1 o'clock. But here's the defensive track, which is everything we do here at TGO except weekly options. You get accelerated retirement. The offensive track, obviously, you get weekly options instead of accelerated retirement. And then obviously the max afterburner, 85% of that. And I think that's right in line with what we're doing. All the new members so far since Wednesday, since we opened the slots, are max as well. You can always upgrade, guys. If you start defensive or offensive track, you can always give us a call and upgrade. Hans, yep. Hans. Everything's recorded. That's what I was just saying, my friend. This is the page where all the recordings are from every thing we've done so far this week. So everything's on that page, and we should be good to go. Real quick, anything else I have to cover? We knocked all this stuff out, folks. We're halfway. Well, yeah, technically we're more than halfway through our full week of live trading and training here at Top Gun Options. This one's on us, right? You guys didn't pay a nickel. Matter of fact, you're getting a ton of value. For those in the weekly options live trade brief, looks like with the Dow essentially flat, the futures flat, and opening to maybe a little bit to the downside as everybody digests what the Fed did yesterday. That weekly options bear call spread's looking even better, even though I sent out an alert yesterday to close it. So Doug is going to kick off here in a couple minutes. His advanced live trade brief and an advanced trade alert sometime later today. And then obviously he and I are going to get together for a debrief tomorrow afternoon at 1 o'clock for about 30 minutes. We'll take any just by the ways or pop-up questions you had on anything we covered this week. And then I'll close out our full throttle week with my weekly options live trade brief. Okay. The advanced live trade brief already gave you the slot update. I covered my administrative items, so we're good to go. Just covered the remaining flight schedule. I'll be in the background answering any questions that Doug doesn't take live. And like I said last night, folks, there'll be a hell of a lot more people in this live session than there were last night, and it was really busy last night. So Doug, again, he's an incredible instructor. If he doesn't get to all your questions, that's unfortunately the way it is with when we open the squadron and everybody's running around in the hangar here. So without further ado, you guys know me, who cares? Doug Robertson, he teaches our advanced live trade brief. He's also our full throttle instructor. So when you register for your full throttle, when you grab your slot, there's going to be 8 sessions that Doug's going to give you as part of your full throttle training. He usually does it. He usually takes a little bit of time after we do this stuff, maybe a week, 2 weeks, and then he'll get airborne with 8 sessions, maybe Tuesday, Thursday nights. He'll send out an email to all the new members. And here's one of the value adds that I always forget to cover is as long as you're here at Top Gun Options, you get access to all of his training going forward. Let's say we do another full throttle launch in January, you'll get access to those 8 sessions as well. That's $495 every time that you do that. That is free. That is all on us. That's pretty cool. Doug's our vol arb trader. He's a quant. He's an egghead, and he wears that title proudly. Ones and zeros, Excel sheets, swinging a big book up there in Chicago, down the street from me. Was a director of European trading, and a very, very smart guy. Private equity manager down here in South Florida. Manages a small fund there for accredited investors. Maybe you can talk about that offline. So with that, I'm going to turn it over to Doug. Let me see if I can answer any of these. Stephen, yes, we do. That's exactly what we do. So, of course, we provide those notifications. So let me throw it over to my vol arb buddy and my Army friend, Doug Robertson. All right, guys, I'll be in the background, and I'll be back at the end there. Doug, you got it, my friend.
All right. Well, thank you very much. Second, let me grab the presentation here. Hold on. It's always interesting that it shows both of us as the same person. Okay. Here we go. Okay. Hey, good morning, everybody. Hey, Silvana. Yeah, by the way, for everybody visiting us, what you're getting right now with me on the camera is, out of courtesy, is typically not the way I do this. Everybody likes to see my face when we do these promos. So once in a while, I actually show up here, and this is me. And for the person commenting on the hair, yeah, hair left me a long time ago. Haven't talked for a long time. Don't expect to be getting back together. So, oh well. Welcome. Let me see here. What do we got going on today? Basically, let's see. News this morning. We've got the jobs numbers out. Pretty normal thing we check on here. 259,000 new job claims, well in line with everything. Not a big thing to worry about. Looking good on that side of things. Big picture stuff that we got floating around. Better to be streamlined in a hurricane. Absolutely. I have absolutely no issues with my hair whipping around in hurricanes. And I even tested that just recently. So looking good on that one. Let's see. Before we get going in the session, this is the getting going in the session. What we typically do on these is we try to get a big picture view. Because I firmly believe you can't trade well unless you know what the heck's going on in your environment. There are lots of things that we bluntly have no control over, and we got to live with that. The fact is the Fed's going to do its thing, North Korea's going to do its thing, the markets are going to do its thing, and someday the market's going to do something we don't even know why it's doing its thing. But we have to keep a heads up as to what's going on. So some of the big picture items that I'm focusing on out there, and let me kind of walk you through some of the things that I like to pay attention to, is get a feel for what's going on out in the markets overall. Now, I want to point something out. A lot of us get news information and things like that from places like CNBC, Market Watch, and stuff like that. Those are a big, huge list of opinions. And sometimes those opinions are misleading. Let's see, getting some questions here. Quick heads up, we have an absolute ton of people here, and for all of my regular customers, I have a position review that I'm firing off. It'll go off right after the end of this. It'll cover all the things we're in currently. I'll try to take all the questions I can, but just understand that we got a lot of people right here, so I'm going to get hit with a lot. I'll try to keep up, do my best. May not be perfect at this. Can I review the VXX double vertical spread? I'm sure Wiz can review that, but that is not my trade. So Wiz focuses on the trades he does because he knows those best. I focus on the trades that I do because I know those best. Let me see. Can I explain what I consider best times to do debit spread and when to do a credit spread? I will explain the differences a little later. We're going to touch on a VXX hedge that I like to do, and that's a great chance for me to explain that. And okay, good. Up to date on questions. Now, I was saying that we get our news and information from a lot of different sources: CNBC, MarketWatch, Yahoo Finance, whatever. These are a ton of different opinions that are being flown around. Now, let's understand a flat out fact about the market, about information for finance. It's lucrative, there's a lot of money generated by it, and it has nothing to do with whether or not you make money yourself. So you get a lot of misleading articles that are full of hype. One of the ones that always drives me nuts, and I just saw it today, is, let's see, how China reclaimed its title as the largest holder of US Treasuries. Excuse my language, but bullshit. Okay? These are a good example of people basically trying to hype things up and lying to you. China has never been the largest holder of US Treasuries, never will be the largest holder of US Treasuries, and isn't even close to the largest holder of the US Treasuries. The largest holder of US Treasuries is you. It is the US government and US citizens. By far the largest holder. You know, they are trivial compared to that. Social Security is one of the biggest holders of that. What I want to point out is be careful of what you're seeing in news. And take everything with a grain of salt. Use it as a way to get an idea of what's going on out there, but do your own research and look for sources that are actual data as opposed to just a bunch of people's opinions trying to make people hyped up and, you know, attracting people to click on websites. Now, a couple things that I am watching. Everybody is paying attention to the Fed right now. That's a big one, real important to pay attention to. Why is it important to pay attention to? Because as the Fed raises interest rates, they're increasing the yield on debt across the board. You know, government bonds, treasuries, you know, sovereign debt around the world, corporate bonds, you going down to the bank, taking out a loan, every single one of those things is going to get affected by the Fed raising rates. But it's also going to get affected by the Fed getting rid of its balance sheet. So once again, we get back to data. Everyone gets all hyped up about what's the Fed going to do, when's it going to do it. Well, here is some sources if you would like. Let's see here. Look in the chat box, and I'm going to give you these links. And these are things that I like to actually look at because they are not opinions. They are data. And I like data because it gives me a much better perspective on what's actually going on. Fed raised its balance sheet by buying up a bunch of treasury notes and mortgage-backed securities from the banks back around 2008, going up to about 2014. That was a quantitative easing program, injected massive amounts of cash into the banks, and they those assets have been sitting there on the Fed's balance sheet. Now, Fed's not actually selling these things. What they're doing is they're failing to reinvest that money into the bond market again, you know, because these things expire and they churn and they turn over. What'll happen is as they do that, they're basically going to be taking in cash, which is going to be coming out of the market, dropping the price on the overall bonds, increasing their yield. So we're stock traders, we're options traders. Why does that matter to us? Huge chunk of, hold on. Huge chunk of this rally right here. This is going back, actually, I haven't even gotten this all the way back to where it should be. Back. Huge chunk of that is safety money. Safety money is moved into the US stock market. This is sovereign wealth funds. This is your Harvard pension fund, your CalPERS, Yale Foundation. These are people who want to just basically stay a little bit ahead of inflation and be as safe as physically possible. That money has gone in here into the stock market, and it's helped to drive this up. We have had the second largest bull run in the history of the stock market right now. And if this keeps going for another year or so, we will be in the official longest bull run of the stock market. I don't care how long it is. I don't care what the reason is. The money that's come into this market shouldn't be here. There's a lot of the money that should not be in the stock market. That is supposed to be in safe places like bonds. But since bond yields are less than inflation, they can't go there. They're losing out. It goes in the stock market. When and if the bond yields and the treasuries go up, that money can go back to the bonds. That's why we are worried. Now, reality of it is, we want to watch this number right here and see how fast it drops. Faster it drops, when it starts dropping, the more effect it has, the more money moves, and the more it can hurt the stock market. Fed's not wanting to hurt the market. Just realize that. That's not their goal. They don't want to do that. So they're going to be careful about it. Do I trust that they can do it perfectly without hurting things? No. So we need to be paying attention. There's a second number that I like to be paying attention to. And this is one that people don't seem to be looking at very much lately. It is this: excess reserves. Simultaneously, when the Fed was buying up bonds and things like that, or mortgage-backed securities, treasury notes from the banks, they were pushing huge amounts of capital into the banks, cash. This happened back in 2008. Why does this matter to me? Because right now we have about 2.2 trillion, that's big T, dollars in the banks that is not being used, that is sitting there, literally sitting there. This is, by definition, excess reserves is the amount of money above and beyond what banks are required to have in their accounts to cover things like people, asking for deposits back and things like that. This is money that should be loaned out, that should be turned into investments, that should be done, worked with to make our economy better. The higher this number goes, the more stagnant money is getting. The lower it goes, shows money is moving into the economy and actually causing a positive outcome. What bothers me right now, the Fed caused this money to go up. The Fed stopped right about here. That money started to drop down because the banks were loaning it out. Now, back around beginning of this year, for some unknown reason, and nobody seems to be able to explain this right now, banks stopped putting out money, and they stopped pushing that money back, and their excess reserves started to go up again. There's a reason why excess reserves might be held on to. The banks get about a 1% return on those right now. That will be adjusted by the Fed as they go. Why do the banks right now think that it's smarter for them to take a 1% return and not use the money rather than loan the money out and put it into the economy, put it into the world, and make a higher return on it from loans? Now, I'm tossing that out as a hypothetical because I don't have an answer to that. And nobody else has seemed to have given me an answer that makes any sense. But if I've got $2.2 trillion that was basically given to me, and I could use that to make money with loans by loaning it out for cars, homes, home improvements, small businesses, big businesses, whatever in the economy, and I could charge an interest rate of 3, 4, 5% on that versus making 1% that the Fed's giving me. Why am I doing that? Because that is literally the decision that they have made between here and here. Nobody else except for the banks has kept this money into the banks. So big question mark hanging over things right now. Why is that happening, and what's going on to cause that? And is that some kind of indication about what's going on in the economy too? Because there is a really good reason why you wouldn't want to loan. You think risks are too high. Or you think that you're not going to get paid enough to cover the risks, which is a little bit worrisome. So there's data point number 2. I wish I could give you an answer as to what this means, but all I have right now is, an indication of something funky is going on out there. So keep an eye on that one. Demand for that money has gone down? Nope, not at all. People still want to buy homes. People still want to buy cars. I will say this, there is one area where demand for that money has gone down, Bill, and that is large corporations are not taking out loans anymore. They're sitting on huge stockpiles of cash, and that is probably affecting this a little bit, but that's been affecting that, that's technically been affecting it for the last 5 years. So that's nothing new. This really comes down to banks' willingness to loan money, and that can be seen in the way that they're applying their credit standards. Now, Equifax getting hacked, I'm sure is going to cause some confusion and things like that. We'll see what happens there, but you know, the fact that corporations have not been taking out large loans might have a little impact, but that would have started way back here. And there is no sudden change in demand that happened on January 1st. I don't, you know, there's nothing clear about that. At least I haven't seen any information that points to that, but we'll see. People not wanting loans, I don't know. I mean, I just don't see the demand changing that much. Waiting for Dodd-Frank to be undone, that's a possibility, Glenn, possible. Although, you know, that actually worries me, because if they're waiting for Dodd-Frank to come undone, then that means they're wanting to move into some risky trading operations, which Dodd-Frank, you know, precluded. And that we've all seen how the banks can do so well with those at times. I'm not sure. By the way, those trading operations don't help the economy. They are just trading. I'd really like to see that money move out into the economy and actually get into people's hands, because that's what drives, you know, that's what drives buying, that's what drives employment, that's what drives a lot of things. Love to see that happen. I don't know, big question, but another data point to be keeping an eye on. I want to just get an idea of what are some of the things that could be hidden black swan events out there in the market. We know about all the stuff like North Korea is led by a nut job firing missiles over Japan and testing off nuclear bombs. That is out there, it's understood, it's known, and yes, that could mess up the markets if we go firing guns in Southeast Asia. I mean, it's such a well-known thing, they even put it in movies. Princess Bride, the Sicilian, you know, don't get into a land war in Southeast Asia. It's pretty well known that you don't want to do that. That's going to hurt economies if we start shooting over there. That is definitely something we want to be paying attention to. But I'm sure that most of you hear enough of that stuff in the news. We also know that tax reform is coming up. We need to see that thing done. I would love to see nice, well done, well thought out tax reform. There's a lot of pressure on that right now, and that affects the business community, that affects the economy, tons of things that could happen there. I will politely say that I think that things are a little chaotic in the government right now, and I would love to see well thought out legislation. I'm not really sure I have high hopes of that at this moment. A lot of chaos going on out there at this point. I'm rooting for it. We'll see what happens. That could be affecting the markets and the economy. And the other thing, the last thing is the fact is we are just heavily overpriced in the market. Now, price to earnings ratios, things like that are through the roof, exceptionally high, which gives us a lot of room for downsides. You know, things could drop, things can crash down. Is there, you know, so there's lots of room for things down. But flip side of this, we've been going up, and my personal belief is we're probably going to still go up. There's room to move. This market doesn't seem to care about a lot of those things. So we focus on two things. What are the possibilities for risk? And we figure out ways to hedge those off, protect ourselves, control our overall risks. And once we've done that, we use that to forget about, not necessarily forget, but ignore during our trading decisions those risks. And then we refocus on what is actually happening in the market right now. Because bluntly, in the market right now, we are going up, and we are probably going to still go up. The most likely thing to happen next is what we've been doing here. Will that change? Absolutely. Someday that is going to flip around and it's going to go down. And I want to know how, I want to know why, I want to understand what could cause it and what can, you know, trigger that, make it all happen. And I want to be ready for it to manage it. I want to protect myself. But for now, I'm going to trade it as it is. Yeah, well thought out from the government. No, I'm not expecting a lot of things right now from that. Actually, I'm not expecting a lot of things from well thought out from the government, period. I just need to know what could possibly happen, how it could affect my trades, and basically build around that. So background, those are some of the things floating around out there. Good way to see this. And here is another link for you. Love this site. Anybody here ever go to VIX Central or take a look at the VIX futures? Why the chart I'm seeing on the Fed Reserve website look different from mine? I don't know. I just go to this link at the Federal Reserve website. Maybe mine hasn't been refreshed since yesterday. As far as that's going, there is the link to the Federal Reserve website. All right, so all of this information, it adds up to traders making an opinion about the market. What's going to happen next? What are my risks? What are things going to happen? What is going on? So one of the best ways to look at that is everybody pays attention to the VIX, but there's another way of looking at the VIX, and that is this website right here. And I love this. Now, the reason I like this is not a bunch of opinions of people getting up on TV saying, I believe this, and another person saying, no, you're full of it, I believe this. It's not opinions. These are people putting money down on trades, making a bet, a vote with their pocket as to what could happen. Now, let me show you what we're looking at here and why I like it. Right now, VIX, the VIX index down around 9.67. I personally think that this is absurdly low, way lower than it should be, especially with all the background risks we have out there. Crazy low. And guess what? The futures market absolutely 100% agrees with me on that one. We have a futures contract that says in 26 days, what am I going to value a VIX futures contract at? And they are right now valuing it at 12.3. That means that effectively between now and October 17th, the futures market believes that VIX is going to jump up, probably go significantly higher than 1230, and they are putting a future value on the VIX of 12.3. Doesn't necessarily mean they're predicting that exactly on that day, the 17th, it's going to be at that, but that is basically implying that they've got a lot of risks built into this market. That is a huge, huge jump. That's a more than 2.5% or 2.5 points of difference between where the futures market believes the VIX should be and where it is right now. That is basically implying that they think that there's a lot of risk coming up in the next 30 days. If you go out a little further to 54 days, they've even priced in a bit more and a bit more. Now, it's normal to have this higher, and it's normal to have this kind of slope on it. What's not normal is the difference that we've got between the VIX right now and what the futures contracts say in 30 or 26 days. It's pretty high. And once again, I like this because this is actually data instead of a bunch of opinions. Everybody can have opinions. If you're willing to put money on your opinion, at least shows you some conviction and shows that you are actually behind that, that idea in some way. So just a little warning, little thoughts. There are a lot of traders out there who are worried about the near future. A lot of premium built into the VIX futures, so keep an eye on that. I like to look at this page pretty much every day. Gives me a good sense, a good trend over time of what's actually going on and how the futures market looks at these things. So a couple of good sites for you to play around with. Even 1230 is still low, absolutely, Kevin. I'm not saying that that's the right number, just saying that the thing that blows me away right now is the difference, the absolute difference between where the VIX actually is right now and where the futures market has it priced. 2.5 points, 2.75, whatever points, that is a ton of difference. Massive difference in opinion here. Guess we'll see what happens. Is it possible to show how overlay this page versus what it actually was? You can go back in history and play with this. I don't have that right here though, so I'm not sure. You'll have to play around with the website yourself. Okay, so other big driver of the market right now, we have earnings season coming up. This is fun. This is one of the seasons that I love a lot because there is a ton of volatility being driven around. Anytime you've got volatility being driven around for specific reasons, you have trading opportunities. Now, the people in my regular group, by the way, everybody who's back today from my regular sessions, just want to say hi. Sorry, today is the promotion where everyone's coming in. So a little bit of a different session today, but good to see everybody out there. Actually, if you guys want, just say a quick hi in the Q&A section, and I'll chat with you as we go. Any prediction value in the VIX? Well, I'd say this, Bill. Hey, Brent, Dennis. Hey, this is one thing that the VIX is very, very good at predicting, or at least this chart is very good at predicting. Not so much whether we will have a crash, or whether or not when exactly a crash is going to happen, or some kind of volatile, risky event is going to happen in the market. It's not overly good at predicting timing. What it is good at predicting at is scale. The more difference that you get between the VIX right now and the futures contract, when and if the market does react to something. We're not talking about the market doing something normal. We're talking about it reacting and it's suddenly moving. That gives you an idea of how much that movement will be. The greater that number, the difference between those, and the steeper the slope that you have here, usually the faster and the bigger the drop in the market. And that's a pretty good correlation. On the other hand, is it perfect about predicting when it's going to happen? Don't trust that. The best thing to do is remember, we're trading the market we have right now. Keep that in mind. Don't try to pick a top. Don't try to pick a bottom. Don't try to pick that moment when everything is going to change. That is such a hard thing to do. Not only do you have to get the direction right, the scale right, but you have to get the timing right. You have to figure out how much it's going to go against you in the direction it's going now before that happens. Focus on what the market's going to do, but then protect yourself against what the market could do. We're going to take both of those aspects today, and by the end, we are going to touch on the VXX hedge that we've got on, and how and why that does its job. And Kevin, absolutely, Wingman Group, I will be reaching out to you on that shortly here. Sorry, we got a little bit of chaos. We had a bit of a hurricane roll through our neighborhood. Both Wiz and I got hit by that. So Wingman Group, looking forward to getting rolling on that. By the way, everybody, Wingman Group is my small group coaching that is a lot more personal, very, very, very one-on-one, and that comes along at a later time. Today we're focusing on full throttle though, so let's dive into some trading. I was mentioning before, earnings announcements. We have an earnings season coming up. It is coming up hard and fast. Let me show you real quick. Okay, this is a little thing that I've got in Excel. Let me explain what I'm looking at here. We have earnings coming up every quarter. Everybody's familiar with that. Companies are putting out information on how well they're doing and how well they expect to be doing. Just a huge drop of information to investors every single quarter. Very, very concentrated, and it can make stocks move a lot. It can change the directions that they're moving. It can gap up, gap down. It can do an absolute crazy amount of effects on its stock. It can change the whole aspect of a stock price movement with one announcement. As far as options traders are concerned, they are risky. Now, that's a beautiful thing. We like risky because risky gives us an opportunity to make money, especially when we're dealing with people. Stock prices are hard. I mean, I'm just going to admit it right now. Predicting where stock price is going to be 30, 40, 50 days ahead of time is a challenge. If I say that this stock is here and it's going to be here, that's a tough one for me to hit dead on. We do our best. We try to get general ideas of where things are going. We use that to our advantage, but predicting where price is going to be is just a tough thing. The flip side of that is people are generally predictable, especially when you get into the concept of fear, uncertainty, and doubt. FUD factor. Love FUD. That is directly translated into implied volatility. One of the best generators of implied volatility in the market is earnings announcements. They are great. They're predictable, they're understandable, you know why it's going to happen, you know generally how it's going to happen, and you can follow the pattern to use that to make good trades. That's why I love this season. Let's take a look at a symbol and let me show you exactly what I'm talking about here. Which program includes earnings season? If you're in my ALTB, we will be talking about earnings seasons. I trade the market, and a big part of the market is earnings. You know, it's interesting too. Let me give you a couple of other things that happen during earnings seasons. The strategies that you can use change. Vertical spreads and iron condors are not a type of strategy or tactic that you want to use over an earnings announcement. They're just not appropriate for it. You know, it's trying to use a screwdriver to pound in a nail. It's the wrong tool. It's going to generate more risk for you than it could potentially generate rewards. So we end up getting limited on the number of vertical spreads and iron condors we take during earnings season. Doesn't mean we don't take them up to that, and doesn't mean that as soon as the stock has passed its earnings announcement, we can't flip right back into those as different trades. But we shift our strategies, our tactics, to a tactic that's appropriate to the market that we're playing with. So the number of opportunities to do trades in one way diminishes, but it dramatically increases in another way. So we're going to be just using the market appropriate strategies at that moment to take advantage of what we've got in front of us. So that means that I want to be paying attention to earnings. I want to be digging into those and figuring out ways to make money on them. Let me take you through, let's see here. Let me see if I can find a good example. Let's see, price line. Yeah, it's a pretty good one. Yeah, okay. Implied volatility. Implied volatility is the amount of money, the premium that option sellers basically bake into the price of an option to protect themselves against a hypothetical move in the stock price, which could cause them to lose money. The more of a risk that they see and the more immediate that risk is, the higher they price their options to protect themselves. If they think that the stock has a chance of moving $2 past the strike that they're selling, they want to charge you $2.50 so that even if it does do that, they walk away with a 50-cent profit. It's how the market works. It's how the options market works. The greater the level of fear, uncertainty, and doubt in the market, the more options sellers take advantage of that, raise premiums, and generate opportunities for profits for themselves. And that's perfectly normal. It is a, it is a trading system, and these traders want to make money. I know the floor brokers. I know the people who work professionally in the options market. I've been to their houses down on the lake. I will tell you right now that they are nice, that they're, that they're great vacation homes, and they weren't cheap. These people want to make a profit, so they're going to use this. What we want to do is we want to understand how that's going to happen so we can jump on board with them and use it too. So let's jump into a quick little review of one other piece of the market. Who's the buyers of these? Because you can't have a market without somebody on the opposite side. A huge number of buyers in the options market are what we call long-short hedge funds. Now, long-short hedge funds have a very, very different motivation than you and I. They combine long stock trades with short stock trades, blend them together, pick a good bullish trade, add in some good bearish trades that they're short on. They create a blended portfolio that's designed to make less money than the overall stock market. I know that sounds bizarre. In fact, has anybody ever heard the comment that hedge funds don't do as well as the average market? That's another BS one that really drives me nuts. Because what they're doing is they're lumping in long-short hedge funds whose specific goal is not to make as much money as the market, in with everything else, and then claiming that it's some kind of scary number or that it implies something horrible. In truth, these guys are actually doing their job. What they're trying to do is make about 2/3 the profits of the regular market in general while taking half the risk. Now, that's a neat trick. It's a good trick. It's a smart trick, but to be a good long-short hedge fund. And by the way, this strategy and that approach is a huge portion of the market. They sell a lot of those services to Harvard Pension Fund, CalPERS, Yale Foundation, those safety people. And one of the things they use is options. One of the reasons they're called hedge funds. They hedge their positions, and they buy a lot of options. And when risks start to get high, especially around earnings, they buy a lot. So this is what drives the situation we're in right now. Let's take a look at this. You see this chart right down here? Green line on this is implied volatility. And I want you to look at these dots. These are earnings announcements. And look how implied volatility goes boom, 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 boom. This is a heartbeat. It's predictable. It's understandable. We know why it's going to happen. We know how it can happen. All kinds of great things about this. And in fact, it's actually a lot more predictable than stock prices are. That drives the trades we're going to do. Because if you're just focusing on stock prices, you're pretty limited. And you're picking something that's hard to predict. I want easier things to work with. So let's see if we can use volatility. Volatility is a great tool for trades. Now, I know that I've got earnings announcements coming up, and I know that that's going to affect implied volatility. So let's jump over to one that I'm working on right now. All right, Netflix. Let's take a look at this guy. Now, a couple of the things you have to understand to dive into this trade. And for all of you who are new, this is going to be a little complicated. Just let me lay the groundwork for this. This is an advanced trade. This is what you get to once you've worked through a lot of the other things. During the Full Throttle program, we will cover all the aspects of how volatility works. We'll cover all the aspects of the Greeks, and we will get you here. So if this looks too complicated, if this looks, you know, a little bit crazy or whatever, don't worry. You know, what you're going to do is you're going to work to this point so that you are trading these things and they make sense. In fact, tell you what, do me a favor. I know that I've got some people out there right now who've been through this cycle before. They've gone through Full Throttle, they came in, and if anybody wants to put into the QA any thoughts or anything on learning these trades, it is something that everybody goes through, and you do. And the point is that once you understand the concepts behind a lot of these things, the world opens up as far as options trading is concerned. Still Greek to me, Tim, okay. Well, that's good. That's what it's supposed to be. It's supposed to be Greeks to you. That's what we're going to use here. But, you know, a huge portion of the trades in the market are not directional trades. The opportunities around the trades are not necessarily directional. A huge portion of it drives rate from volatility. That's a big part of options pricing. So let's use the volatility to make money. And why ignore 2/3 of your possibilities? All right, Netflix. Let's just take a look at something. Last quarter, we had Netflix with an earnings announcement on 7/17. Now, I'm going to use tool. Think back. All right, hold on. July 17th was the earnings announcement for Netflix last quarter. Now, I am going to go about a month before that, and I want to show you something that's going on with implied volatility. So I'm just going to go back to about the 20th, and I want to show you something that's happening here. And we're going to see this happening right now in the market too. Here we are, we've got the July 14th expiration. Now, the implied volatility is about 26% on this, which is a normal implied volatility. You'll see that implied volatility on the options that expire earlier than that, 29, 27, 26, 26. And then suddenly it jumps up to 43. Big, huge jump there. And there's a really good reason, because these options right here are not exposed to the risk of an earnings announcement. They expire beforehand. They're not going to be there. This option right here is exposed to the risk of the earnings announcement. And the people selling this, the market makers and the professionals and the smart guys out there playing with the options here, know that they have to sell these options at a higher price to cover the risk that they might get hurt or basically have the stock blow through their strikes when that earnings announcement happens. Now, the interesting thing is, the further out from the event itself, the less that affects the options price. So we're going to take a look at these two options. We're going to watch it. So each day, here is June 20th. And I am moving forward. Let's just jump up a bit. Now, implied volatility on the 14th of July expiration, 28, changed a little bit, not that much. Very, very small change. This is now from 43 up to 48. And here we are on the 7th. We are about 10 days before the earnings announcement. Implied volatility on the July 14th, still relatively low, hasn't really significantly changed. We are now up from 43 to 59%. Now, let me make a point. Implied volatility means the option price is going up. The value of those options is increasing. On this one, it has not increased. On this one, it's increased a lot. And here we are on, let's see, the 14th. And wait a second there. Implied volatility on the options that expired beforehand, still right about 30%. Options that expire immediately after, up around 70%. Huge, huge difference. So remember that. If you go back through any earnings announcement, you're going to get patterns that are very, very similar to this. In fact, we use this in this trade. We know that we're heading just about to this number. It might be a little higher, it might be a little lower, but I'm going to be heading just about to this implied volatility. So let's make a trade. Manny, yes, sorry about that. Yesterday you asked me that question, and I meant to answer it, and for some reason I got distracted. So do me a favor, Manny. I'm not going to focus on that during this section right here, but as soon as I get done, I'll touch on what that chart down at the bottom is, and I'll give you a full explanation of what's going on. Okay, next thing we got to do, we know the pattern of what's going on with Netflix. Now we have to figure out, well, that's the pattern of what's going on with the volatility in Netflix. Now we've got to figure out something else. What's going on with the price of Netflix? That is, actually, I'm not even going to make that terribly complicated. In general, what's going on with the price of Netflix? It's going up. In general, it is heading higher. It's got a solid trend here. Now, we had a little bit of a pullback. Back here was related to when Amazon had its pullback. A lot of the tech sector got dragged down along with it. And then, boom, the earnings announcement came out, reset the prices, and got everything back on track. Everyone's all excited again. Probably a little over-enthusiastic, pulled back, and now we're heading right back up. Now, a couple of things I want to point out. This right here is really, really good for us in this trade, because this was the chaos created by the last earnings announcement. So people have a really short-term memory. They love to remember the last time that this happened. You know, the last time I had a birthday, it was horrible. I don't want to have a birthday again. The last time I bought a car, it was a great decision. I'm a great car buyer. The last time I bought a house, oh, how horrible. My next house, I'm so worried about. People focus on the last time things happen. So if you are a person trading options, selling options especially, and you saw this gap right here, which created huge amounts of financial pain for option sellers, are you going to be thinking, man, this time I've got to raise the prices on these options even higher? Yes, absolutely. That is going to be one of the first thoughts in your mind, which means that it's very likely that this time around implied volatility is even going to go higher than it normally does, which is perfect for us because we're going to use that. So direction, heading up. IV, we know the pattern. Let's design a trade. First thing, we are going to create a trade that's using a long option after the earnings announcement that's going to go up in value. And then we're going to pay for that trade, or at least a good chunk of that trade, with a short option that's going to expire before the earnings announcement. So let's dive in and look at that. Let me also pull up a little tighter chart here. We have to figure out roughly where we think this thing's headed, because I want to have a target range for this thing to work. I know that somewhere around 190 or 190-250 are a couple of strikes I can play with, and they're pretty solid in the target range for where I think Netflix is going to be over the next couple of weeks. So let's start playing around with this thing. The next earnings announcement is going to be on the 16th. I want to find an option that is going to expire before the 16th. That puts me on October 13th. Great. I want to find a strike. In this case, we're going up. I want it out of the money. That means we're going to go with the calls. I'm going to start on the 192.50 strike on the calls. And I'm going to sell it. And I'm going to receive, actually better than a 178. I'm going to receive a nice little credit on that. $1.78, $1.80, somewhere in that area. Now, this option right here expires before the earnings announcement. It's not even going to exist during the earnings announcement. This trade isn't going to exist during the earnings announcement. What's going to happen is, in fact, technically, we're not even trading the earnings announcement. We're trading the fear, uncertainty, and doubt going into the earnings announcement. Next part. Now, remember, let me give you a little set of rules around the strike that we're choosing here. Let me give you an understanding of what we're going for. I want to have a strike that I have a pretty solid confidence that Netflix is going to head towards, or at least get close to, over the period of time between now and October 13th. So October 13th is 22 days from now. What I do not want to do is put a strike on so close that it blows through this strike and goes past it. And I'll show you why in just a second. So we want to find something that's, good probability it's going to get there, or at least get close. And second, we don't want it so close that Netflix goes straight through it and makes the trade not work right. So right now I'm going to start with 192.50. We can adjust our expectations if we want. We can move this down to 190, or we could move it higher if we felt like. But starting with that, now here's the meat of the trade. October 20th. I want to find same strike, same side, call 192.50, and I'm going to go long on this thing. I'm going to add it to my position. So between these two, I now have $3.78 in debit. I had a $1.80 something in credit, offset the cost of my of the money I spent on the long option, got my cost down, leveraged up the trade, and actually made the trade work a lot better. And it gives me this. Now let me just double check something. Okay, so without sizing it, without anything like that, we're going to spend about $3,600. We'll adjust that to the right size, and we have a chance to make $480 if we land in this tiny little range. That kind of sucks. That's what a lot of people are seeing. That's what a lot of people would look at and say, nope, not going to take this trade. That's not the truth, though, because we know better of how this is going to work. This is what people miss. A huge chunk of profits in options are driven by volatility changes. So if you don't take into account the volatility change, you don't know what the trade looks like. And you don't know whether you've got a loser trade, which is exactly what this looks like right now. This is a horrible loser trade. I would never touch this thing with a 10-foot pole, versus what the trade actually is. So let's take a little look at the reality. We need to make some adjustments so that we can figure this out a little bit better. A few minutes ago, and by the way, I've done the analysis on this, and actually some of my wingman guys and I were talking about this just the other day. We were going into it. Quick little shout out to Curtis and Juan, and they were actually two people that I was talking with one-on-one on this, and they brought the trade up and we were digging into it, and it was such a good idea that I like it, gonna roll with it. This trade needs to be adjusted so we can see what's going on. So this is a little tool, and I love how they hide this thing away. Probably one of the most important tools you have, and they put it behind this little tiny icon here, and then make you click a couple of things, and I can start adjusting the implied volatility of this trade. So what I want to look at is the 20th of October, the last time when I just went through this whole cycle, implied volatility hit 70% on roughly the day that this trade is going to expire and I'm going to get out of this thing. So to get me, we're at 40% right now. To get me to 70%, I have to add 30 percentage points here. And as you go through the full throttle classes, you'll see how this all fits together, and you'll get a good idea of what makes this work. Why does this work? And so I'm going to add this in, and it's going to change the trade a lot. Now we have a totally different game. And let me just do something real quick. This trade now is a world of difference from what I would have looked at before. And it has everything to do with the fact that we know implied volatility is going to go up. So let's take a look at a couple of things. Currently, the price is about 185. That's this line floating around right here. I'm going to change this line, which is our target, 192.50. There. If we were, okay, let me preface this. Trades never work perfect. Don't expect them to work perfect. Don't set your expectations around perfect. We want to be good, and we want to consistently be good. If we were perfect on this trade, we would be able to walk away with about $3,800 on a trade that costs about $3,600. We are not going to be perfect, but that leaves us a lot of room, a ton of room to be imperfect. And I love that, because I would love to have a trade where I can make some really good money, get paid extremely well for the amount of risk I'm taking, and have a lot of wiggle room on making a profit. So here, let's look at how we can read this chart right now. This is the P&L at the expiration of the trade. This is basically looking at it on the 13th, 14th of October. Now, this will be a little different on different days, and I'll play around with that and show you some different things here. But as long as we are above 183.30 or so, we are going to be in a profit. As long as we are below 202.50, 202.60, we're going to be at a profit. This is our profit zone. Our max profit is over 100% if we were to go for that. Now, what's going to happen is this is going to be developing. We've got two things going on. Implied volatility is going up, and theta erosion, time erosion is helping us on our short options. These are eroding towards zero. They're basically giving us money in our pocket. The long implied volatility is increasing. Between the two, we're creating this nice zone of profits. Now, how is this going to look earlier in the trade? Because we're not necessarily going to do this all the way to the end of the expiration. We're going to go for a profit target and get out earlier. So I'm going to change this and just say that we've made a little bit of implied volatility, at this point only about 4%, and I'm going to change the target date that we're looking at. See, we're on the 21st right now. Let's assume that we got that 4% between now and ALTB class next week. So this right here, purple line, it's what we call intermediate P&L. Between now and then, if we do not move at all, we have implied volatility giving us money, and we're making a small profit. More to the point, if we do move, we are up here around $1,000 in profit at the peak. As time passes, implied volatility is going to be going up, just like we always see coming into these earnings announcements. And we're going to be getting higher and higher potential profit targets. So what we have now is a choice. The lower the target we use for a profit target, the lower the return on investment, the higher the probability we're going to hit it, the easier the trade is, the quicker we're going to get out. That's a good thing. But flip side of that is we make less money. It's a choice. It's a trade-off. There's nothing right or wrong about either of those decisions. If you're a very aggressive trader and you want to manage it, you're willing to take the risks, you can go for a profit target up to probably 100% return over the 3 weeks. If you want to be more conservative, if you want to have less risk, if you want to have less management, and you want to go for a smaller profit target, which is what I'm going to do in this trade, we can go for a smaller profit target, have a lot more consistency, a lot less hassles, and make money in a better way. Or, excuse me, that was a judgment call there. I think it's a better way because I personally like to walk away from my computer and let the trading platform do my work for me periodically. So what I want to do is just flesh out roughly what are some decent profit targets. If I'm looking at the third, now we've got about 8% implied volatility in at that point, maybe a little bit further, maybe a little higher here. Now remember, we're adding 30%. I'm not actually being overly aggressive about this right now. We could be hitting about $1,500 on a $3,600 trade. So I'm starting to get a little sense of how high could this go and when could I be hitting my profits. What I would like to do on this, so let me adjust this again, is I'm going to take this a little bit conservative. I'm going to go for about 35–40% return. In fact, let's just go for 40% right now, which I'm very happy with. I'm making 40%, or have the potential to make 40% over a period of about 2.5 to 3 weeks, which is great as far as I'm concerned. Excellent return on a trade. My break even is below the price that I'm at now, so I even have room for this stock to kind of go back against me a bit. My probability of success in this trade is well over 50%. In fact, I'd have to run some numbers on this, but we're probably looking at the 65–70% range of probability of being profitable or higher. So we've got way better than 50-50 odds on this. And we have a bunch of things going in our favor. The trend looks good, the market looks good, and the situation looks good. Everything's lining up. We've got a potential trade here. Now, I want to take a quick look before we make a final decision on whether this trade is go or not, is risks. Because you never take a trade without having a clear understanding of how your risks are going to work and how things could blow up in your face. So, a couple of things. Could this trade fail? Absolutely. Always remember that. No question about it. Trades can fail. You will have a large number of trades fail. That's not something to worry about. What we want to do is we want to be collecting up more profits than losses and keep us heading in the right direction. That's what we want to do. That's the goal. Being perfect and only picking trades that won't fail is foolish. You'll never get there. You're not being a trader. You're being, neurotic. So how is this going to fail and how are we going to manage it if it does? A couple of possibilities here. One, we have kind of a normal failure. Stock starts moving down, starts drifting down, which is possible. And at that point, we're going to be moving down, and as it goes down, it's going to have the profits going down until we have a loss. We're going to have a plan in place that says, we're going to be watching if the trend changes significantly. If there's a reason it's going down, we are going to control the trade by making a decision to get out. Second part, we're going to be putting a stop loss in there or an eject point in there that says when the pain level gets this high, stop thinking and just get out. Now, it doesn't mean we completely abandon analysis. It means that we don't let ourselves do I hope it's going to go up, I wish it would go up, the hopium trade. That's not what we do at that point. We cut. Unless we have an extremely, specific reason to stay in, we would basically walk away and cut our losses at that point. But there's another possibility. What happens if the market comes crashing down in some form of a correction? Any of those black swan things we had floating around out there. Little Asian guy launches a nuke. We've got, a economy that's extremely hopeful for tax return, and for some reason, outside of all expectations, the Senate and Congress can't seem to figure it out. Causes things to pull back. I don't know. The point is, I don't need to know. What I need to know is what's going to happen to this trade if one of those situations happens. So let's put the scenario in. Here I am. I am on the 5th. Right now, I have implied volatility that has moved up about 10% on this. I haven't gotten all the way to 70. I'm only about 50 right now. And suddenly the market goes into some kind of crazy correction, or the market goes down. Now, if Netflix was drifting down, we would just have implied volatilities kind of doing what they normally do. But if Netflix was crashing down because the market was crashing down, we would see a nice burst in implied volatility across the board in Netflix. So I'm going to add in, I don't know, let's say another 5% implied volatility on the shorts, and then add in an additional 5% on the longs. Now, when I do this, I want you to watch this line right here, because this line right here is what we're going to be dealing with as this happens. We want to plan out the scenario so that we know how to deal with this and manage it as the market goes, basically against us fast. So that point right there, break even is 183.85. In fact, I'll even stick a little. Okay, whoops. It was 183.85. When that implied volatility change went in on the longs, my break even actually moved down to 180. As things get bad, implied volatility goes up, and implied volatility increasing actually makes this trade better, which reduces our risk as things get bad. Does not mean we won't lose. If Netflix is dropping down to 175, we're still going to have to manage the trade and get out. What it does mean is we're going to lose slower, we're going to lose more under control, and we're going to be able to manage the risks better. And that's understanding how these things could fail. Now, that can happen on any trade, that can happen in any market. We just need to know how we're going to manage it when and if it does happen. I still think that this trade looks pretty darn good. So, and by the way, this is a pretty common trade. This is something that the type of thing that we would do quite a bit. As earnings season comes up, I have literally a great big huge list of these. In fact, you see this huge peak, this right here, this is 30 earnings announcements on one day of high, high options traded stocks. Here's another day with 25. Here's another day with 18. All of these are opportunities that we could be playing with. Not every one of them is going to be perfect. Not everyone's going to lead to a trade, but there's a lot of chances to be doing stuff like this. So lots of things in the near future. Overall, I like the trade. Let's figure out how we're going to actually trade it and make it work. We have to have a couple of things in place. First of all, I want to figure out how I'm going to manage the risk if things really go bad. I'm going to start out with a pretty straightforward policy on this. I'm putting this 40% stop loss. Now, I could go tighter stop losses, I can go wider stop losses. The way I do these trades is I allocate my trade size by the risk in the trade. So it doesn't necessarily mean that I would lose more or less by tighter or wider. What I want to do, though, is I want to give this trade plenty of room to do its job. We have a good setup, we have a good opportunity, we have good analysis of what's going on. Let's let it do its job. So 40% gives me plenty of wiggle room, but also 40% says that if you hit this, something's really wrong and we need to get the heck out. Once again, I don't want to be managing my trade by stop loss. What I want to do is I want to manage the trade by what's going on and make a good decision about what's happening. Ideally, close the trade out if it's going bad well before I hit the stop loss. The stop loss is there to make sure I don't make stupid choices. It's a hard and fast, you're hitting this, stop getting hopeful, stop wishing, stop doing these other things. If you don't have a serious reason to hold on to this, get out of it. So what is the stop loss in this? $3.64. I'm going to have a 40% stop loss, so that would be times 0.4. Means I would lose $1.45 each. Okay, flip side of that is, what is my actual stop loss price? It's actually easy, just $3.64 times 0.6. If the price of the stock, or this part of this trade, excuse me, hits $2.18 and I close it out, getting a credit of $2.18 against my initial debit of $3.67, I have lost 40%. That means I lost $1.45 on each one of these trades, which is actually about $145 for each of these in real world money. In the ALTB, we run with a $100,000 portfolio. That's just the basis of what we use to keep everything kind of stable and understandable. And through experience, through kind of policy, whatever you want to call it, I've come up with this basic formula that allows me to figure out how much I want to put into this trade. I want to allocate about 2.5% of that portfolio to this trade. So $100,000 portfolio. You can use this formula yourself if you want. Times 0.025 is 2,500 bucks. All right. So if this trade blows up and does something stupid, I want to limit this trade to roughly $2,500. Now, it's not perfect. Sometimes I lose a little bit more. A lot of times I lose less. I want to try to lose as little as possible when I'm losing and things are going bad. Pretty obvious. What I don't want to do is have, on average, my losses equal much more than $2,500. That allows me to diversify, keep a portfolio of a good, solid number of trades, which is an important thing when you're trading, and makes it so that any one trade isn't going to blow up my portfolio. Now, I don't put it on max risk, and there is a risk that for some reason, maybe Netflix goes down to 50 bucks and we take a max loss on this. This will still keep us within a very reasonable range. It's a very low probability of that happening. But I don't do that because max risk doesn't allocate the trades very well, at least not the way I look at it, my personal opinion. So I'm going to risk 2,500 bucks. Each one of these is 145 bucks in risk. I can take 17 of these. Call me a little neurotic. I like round numbers or numbers that make sense to me. So instead of 17, I'm just going to round that to 15. So here we go. We have 15 of these on. Now, let's have a plan in place. We got 15 of these on. I already know that my eject point on this thing is, hold on. Let's see. And by the way, I see a bunch of questions up there. Let me just get through this, and then I'm going to answer all the questions front to back on this trade. So if you don't hear me answering your question right now, we got a lot of people in here. I will come back to you in just a second and go through those. But let me see. We have a stop loss of 218 or eject point of 218. Now I want to find the other side of this. What is my profit target? I'm going to shoot for about 40%. Now, let's talk about this. There are trade-offs. The more reasonable, lower the profit target is, the easier it is to hit, the more probability you have of getting out, a higher probability of success in the trade, the less time you're going to be exposed to some kind of risk of a pullback or anything like that. I think the trade's good. Doesn't mean something bad can't happen. So if we put in a smaller profit target, we can hit it faster, expose ourselves to less risk, walk away from the trade quicker. If we use a higher profit target, we make more money. There's a trade-off there. So, and by the way, if you're looking for a perfect formula that says do this every single time, there isn't one, because I can't give it to you. I can tell you certain things that'll help you. If you're an aggressive trader who wants to stay on top of their trades and sit in front of the computer and actively do this as a day in, day out job like a day trader, go for the more aggressive targets, because you're going to be able to manage your trade in a more active way. You're going to earn that money. It's not going to be given to you. You're going to earn it. On the other hand, if you want to be a little bit more passive, go down a little bit lower. Put a 20% profit target in. Much easier to hit. Let the computer do the work for you and lay in a profit target on the trade like I'm about to do. Walk away, walk away from the trade when it hits that, and you've got money in your pocket. Refocus on the next opportunity. Wherever you are in that spectrum, you can always adjust this up and down. What you don't want to do is put in a profit target that's just impossible to hit. If I put in 200% on this thing, not going to happen. And you probably don't want to put in a 2% profit target that's not going to get you over your commission costs. So I'm about middle of the road. I'm shooting for 40%, which is very, very reasonable in this situation. So wow, this thing's moving around a lot. We would have already made some profit in the trade if I hadn't kept talking. All right. I'm going to leave that stop loss roughly where it is, but I'm going to take 391 basically times 1.4, and that's going to give me a price on the profit target. So firing the trade off, and boom. Okay. Order is sitting there. It is waiting. Let's see. I've got a price out right now at $3.91, which is a bit higher than where we were. There's some wiggle room on this. I'd probably go up to about $4 or so before I tried uncle or reevaluated the trade. I'm going to sit here and we're going to try to get a fill on this. If I get filled at $3.91, my profit target is going to be $3.91 times 1.4, $5.47. I could put a little effort into figuring out commissions and things like that, but commissions are very tiny on a $3.90 trade. We're probably talking a grand total of 4 cents. Doesn't move the needle very much. If this trade was a 30-cent trade, I put more effort into figuring out the commission aspect of it. But on this one, don't have to care too much. So $5.47 is going to be our limit order to get out of this thing. Now, we have a game plan. We've got 1 or 2 other things that we've got to take care of while we're waiting for this thing to get filled. And by the way, there's our fill. Good. We have to have one more rule on this trade. And let's see. One more rule we need on this trade is this. If Netflix goes up too fast, shoots by 192.50, and it isn't in this earlier area here, especially if this happens early in the trade, we need to control the trade. We may not hit that 40% profit target. So what we need to do is have a little plan that says if we hit 194, we liquidate the trade. Now, this is not a stop loss. We are probably not losing money at this point. We're probably in a very, very nice profit. We could be up 15%, 20%. Probably it's not going to be 40%. It's not going to be hitting our target, but we would probably be having a decent profit as long as this isn't too fast. If it happened tomorrow that Netflix jumps up above 192.50, yes, we would most likely lose a little bit of money there, but not a lot. But the point is that if Netflix is moving up that fast and it continues to move up, we're going to be on the wrong side of this curve and it's going to start hurting us. So first thing we've got, profit target, which we're putting out at $5.47. I'm going to put that trade in just 1 second. Second thing we've got, if Netflix goes above 194, I need an alert that tells me, wake up, close the trade. I need to focus on this thing and close it out. Take a little bit of a profit, refocus on other trades. Final is eject point, which is $1.45, and I'm going to set an alert that tells me when I'm getting close to that. Actually going to set an alert that warns me a little ahead of time, and we have a game plan for the trade. Other than that, we want to be paying attention to Netflix and see if anything major happens on the chart and if there's a good reason for it. Did any news come out? Did anything that says that Netflix is going to get hurt? Blah, blah, blah. All those different things. We just want to pay attention. Is the situation changing? And if so, we need to evaluate it. The reason for the trade, is it good or is it bad then? If the reason for the trade changes or if it's no longer a good trade, we close the trade. We never do a trade without a reason. So if the reason goes away, we don't leave the trade in. That's gambling. We don't gamble. Now, let me do one thing real quick. I have a bunch of people who need to get this as an alert. So give me 1 second and then we'll wrap this all up. And then I'll answer any questions. Okay. Sorry for the pause here, but it is important. We got to get these alerts out. There are people who are not in this class right now that expect to get these. So we have to pause a moment and listen to me type. right. Almost there. If you signed up in the full throttle launch promotion and you gave your cell phone number, you should be getting a text message right about now that's got just the basic details of the trade. After the class is done, I spend some time and I write up a full write-up that goes top to bottom on the trade, gives you all the information you need to know. But what I want to know right now is that you've got the trade information in your hands fast. And one last thing. All right. Good. Okay. After the class, I'll be setting up sending out a full trade profile, shows all of the different things, and it's going to have the different pieces that I'm about to deal with in it. So let's see. First of all, this. I'm going to create a couple of alerts. This is our trade. I want to know what's going on the trade. So if the mark price, which is the price of the trade in the market right now, is at or below, remember we said we've got an eject point at 145, I am going to get warned if the trade goes below 165. So a little note. To myself, heading down close before 145, I just want to make sure that I don't go down to that stop loss. So that's a quick little alert to myself. I recommend doing this. It's a good way to control things. There's one alert, and the second alert is when the stock price, hold on. Just a second here. No, I don't want spread. Sorry, things fighting me right now. Okay. There we go. When the NFLX stock is at or above 194, I want another alert to me. This sends it out to my cell phone, email, bings on my computer. There. So these are that. As soon as I see any of these things, or if I make some choices and manage the trade, I will send out alerts to everybody to let you know what's going on. Now, questions, and I know we've got a ton of it. Let me go back a bit here. Tom, student, wow, way back then. Tom, the question was about some spreadsheets that I had years and years and years and years ago. That was a long time ago, Tom. Wow. I have updated, changed, and I'm actually doing a lot of updates on things right now. So still use spreadsheets, and you can actually see one of them that I was playing with right here. Use it to gather up information, organize things, and help understand it. So yeah, anytime I have a spreadsheet or a tool that is working and well done and clean, and by the way, this one that I'm looking at right now has a couple of bugs in it, so I'm a little nervous about sending it out. I share it with everybody. It's a standard policy. I'm not It's not an extra cost. It's not a fee or anything. It's part of what I do. So yes, I do have more tools. Let's see here. TGO moving the market again. Yes, that's what we do. We, I'd love to do that, but no, probably not. How to set an alert to get out. Hopefully you just watched that. Now, I'm going to do one more thing on that trade in just a second, and that's actually going to put a limit order price for a profit. On the stop loss side and the risk side, I have to alert myself and pay attention. I have used stop limit orders in the past. One thing though, please do not use stop loss orders in the options market. Horrible way to lose a ton of money. Stop loss orders get you filled at horrible prices, and you can sometimes lose more than you ever thought you would. Stop limit orders trigger at a certain price, but they put out a limit order to control your risks for slippage when you're exiting. Problem I've had recently, Thinkorswim has had some issues with their system and kicked me out of orders and actually kind of pissed me off. So right now I'm back to using alerts, which basically means that I send an alert that says when the trade gets to close to this, I leave myself wiggle room, I send myself an alert, my phone beeps, my computer beeps, I get an email, alarms go off, and I deal with the trade. That was what I was doing with the alerts. I think that's pretty effective if you don't want to use stop limit orders. Now, Richard, so ideally this trade, would we want to close us on expiration of the short or hold on to the week of the earnings before the earnings date? We never, this is a trade as a unit. If you leave if you go past the short, let's go back to the trade, by the way. If you go past the short and you just leave the long, you're in a totally different trade and it does not work the same way. At the latest, absolute latest, we would have this trade 100% closed out by October 13th at 4 o'clock. That's the Friday when the short options expire, and that's closing the long and the short together. Now, what's great about this is it leaves us open to the flip side of this trade, which is playing the volatility as it comes crashing down after the earnings announcement. There's actually two totally separate trades here. We'll deal with that one when it comes up. But no, we do not ever leave this trade on afterwards. My goal actually is this. And I am going to, let's see. Here's my Netflix trade. I'm going to create a closing order right now. And my profit target is $5.47. And this is one of the ways that I would personally recommend doing this. It's great. If it hits this, I've walked away with a 40% profit in, let's see, less than, well, right about 3 weeks, or less than 3 weeks, most likely. So what I'm doing here is I'm creating a limit order. When the market gets to the point where this trade is worth $5.47, somebody will take the trade, fill me, I'll walk away with my credit, and I've made the profit about a 40% return on the trade over that period of time. So if I did that, let me see here. I'll have $2,355 in my pocket minus a little bit of commission. So not bad for a little bit of work over a couple of weeks. Return on investment on this one's pretty high. So this is the primary way I want to get out. Now, I could adjust it. I could go more aggressive. I could go more passive. I could just manually manage it if I felt like I was getting up close to some number that I wanted. But right now, this is a nice consistent way of just targeting a price to get out and making a good profit. So I've set up my trade. I've got my limit order, got the price in, everything's good. I need to make sure it's good to cancel, which means that this trade is going to exist into the future until I cancel it. It's not going to cancel tonight, and I'm going to send it. There, done. So when that hits, I've made my profit. Let's see here. Why am I showing an immediate negative P&L on the trade? Wide bid ask. Might be down a little tiny bit. Hold on. Yeah, remember, we can have little flickers, little twitches on this, a few cents here and there. Don't get hung up on small little things like this. The trade is good. The idea is good. Even if we were down $500 today, It's not something that's going to make me sweat. Now, if everything changes and there's a reason it's changing, I'm going to pay attention to that. I'm going to control the risks. You know what this really means is if you're waiting out there right now, you can get filled at a better price. It's good. But I'm not going to worry too much about this. And bid-ask spreads, Netflix is a pretty actively traded symbol. You should get a fill on it fairly fast. All right. Let's see. Okay, share my TOS tool, vol tool for import. Absolutely. Actually, I share all the tools. In fact, this is a good chance for me to go into that. Let me finish up with any questions on this trade. Let me show you that tool that I do have on the bottom because I've had several questions about it, what it is, why I use it, things like that. And all of those are just part of what we do. In fact, every single week when I do the recap for my ALTB session, there's a link to download every one of those tools and load it right into Thinkorswim or spreadsheet or whatever you have right there. So absolutely, anything I have and I'm working with, you get a copy of. It's, as I said, what I do. Brent, I'm looking at a 40% loss from the entry price, which is my risk on the trade. So I'm basically taking a 40% loss from the risk, not a 40% loss from my target profit. That wouldn't make much sense because that would basically mean that I would get out immediately because I'm shooting for a 40% profit. If I had a 40% loss off of that, it would put me right where I am right now, and I would get kicked out of the trade. My stop loss and my eject point is based off of the price entry that I got. Now, I will say this. The price entry was a little bit off. I think I was calculating that target price when it was about 372, 378, somewhere in that area. We got filled at 390. I could just rejigger that a little bit, recalculate it, and put a 40% stop off that. It's only going to change it by a few cents. I'm not too worried. You know, we're still landing within the right zone. If you want to be exact, absolutely. Some people, you know, want that. It's not that significant of a change though, so I'm comfortable with where it's at right now. All right. Do I use straddles for earnings? No, I do not. Straddles, you're buying a long put and a long call. What you're end up doing is you're biasing yourself against the trade in two different directions. Basically, the long put is overpriced and you're overpaying for the potential movement on the put side. The long call is overpriced. You're overpaying for potential movement on the call side, and you are basically setting yourself up statistically to being negative expectancy on the trade, which means basically on average, if you take that trade, you're going to get hurt over the long run. You can win sometimes, and you can absolutely make some great money sometimes, but on average, the market overprices risk, which means that you're behind the curve. It's like going into a casino. If you sit down at those slot machines and you keep pulling that lever, in the end, you're going to be broke. So no, I don't do that. But there is a very, very good trade you do for earnings, which is actually really similar to what we just did. In a couple of weeks, we'll have a whole stack of those that we're going to do. And it involves mixing a short option with a long option, because what really is going on there is implied volatility is crashing. And that gives you a great opportunity to make some good money on a very short-term trade. You know, very common for us to be making 20, 30, 40% on a trade in literally overnight in earnings announcements. So it's a great way to do that. But I wouldn't recommend straddles. For some reason, that's become a strategy that some people push, and I think it's overall really not good for you. My 2 cents. All right, let's take a look at a couple of the things. I set my alert. Let me just double check those numbers, Brent. I got to fill at 390 times 0.6, 234. Okay, thank you, Brent. See, this is, see, if I listen to the people here once in a while, I fix problems. My stop loss is, as he pointed out, it was low. It should actually be stop loss of, or an eject point at 234. I'm going to fix that right now. And thank you. You did just catch an error on that. And I'm going to put an alert at about 265. So let me fix that real quick. Actually, I'll tell you what, I'm going to do a verbal on that one. I'm going to fix it after the session's done. But I did make a mistake as I was rushing through these. I put my stop loss down too low. The eject point should be 234. Let's say 235 on this. And I'm going to set an alert for 265. And all of those details will come out in the full report after the class. So thank you. Good heads up on that one. Does it matter that you use call or put for this Netflix calendar spread? Technically, no, it doesn't. But there is one thing that you want to be dealing with here. Remember, I've got a short option in this. I've got a 192.50 call that is short 15 contracts. I could actually do this exact same trade using puts. And there might be a little volatility difference or some things that might help the trade out, and you can absolutely do that. Strangely enough, it doesn't really affect the way the trade looks. What it does do is one thing. It puts the puts, if we use the 192.50 puts to create this trade, it puts the short put in the money, which exposes you to the risk of assignment. Now, that's not a horrible thing. You actually are getting paid out earlier on the trade if you do get assigned, but it exposes you to holding 1,500 shares of Netflix. So your broker can get a little pissy about the margin requirement for that. And you've got risk of the stock price moving. So in general, I use the out of the money options. In this case, since we're heading up, out of the money is the calls. So does that answer your question? Okay, why did I pick 192.50 and what is the base for the price going up on? It is pretty much this. I'm looking at the overall general trend. I'm looking at the time frame I've got, and I am picking a point where I believe that if this thing were to keep going on its general trend, it is going to have a high probability of hitting this 192.50 level later in my trade. Now, I kind of want to make it so that if Netflix goes up quick, you know, I've got enough room to not have it exposed to a quick movement. I'd actually solidly considered using 190, but Netflix moves around so fast and it's on such a solid trend that it could go through 190 in the next week, and that would be too early. I wouldn't be able to make, you know, a good profit target on that one. I would have a little bit more room to the downside if things moved, which could make it a good idea, but I've got more risk if the thing goes up too far to the upside. 192.50. It's far enough out there. I don't actually need it to get all the way to 192.50 before the end of this trade. If we were up around 190, 191 near the end of the trade, I'm going to hit my profit target well before 192.50. So that's the general thinking and the thought process that I'm putting into this. Overall, I think that with the trend of Netflix, we've got a good shot of that. I don't want to put the target too far out because I want to have a good chance of getting there. I don't want to put it too close because I don't want to overshoot. So we're kind of going for a Goldilocks zone. Is my answer of 192.50 the only answer you can go with? No. You know, everything we teach here is understand the principles, understand the idea, use your own thoughts, use your own head, and pick a choice that makes sense for you. If you want to target something lower, you can. Understand that you're adding a risk to the top side. If you want to pick something higher, you can. Understand that you are creating a trade that's going to be harder to win. Trade-offs, all about trade-offs. So there we go. Similar for the put option, can we use out of the money options? Not on this trade. If we are trading 192.50, we are using a 192.50 strike. Doesn't matter whether we're using call options or put options. I could legitimately create this trade using put options. In fact, I'll even prove it right now. Okay, get rid of this. Here we are, and I am going to flip these around to puts. Notice how nothing changed? It's because it is effectively the same exact trade. But I am still targeting 192.50, and that means my strike is 192.50. And if I do this trade and I am targeting 192.50, because by the way, I could make this with a put option and the put option out of the money. That means it's going to have a strike down here. I don't think Netflix is going down here. So if I put this trade on where I believe Netflix is going, which I think is the right move, I have to use somewhere around 190, 192.50. And that means that my short put option's in the money. We are currently trading at 185. I could get assigned on that, and it could cause lots of hassles and mess up the trade. So I don't do it. That's my reasoning. If there's a hard route and a simple route, I'll take the simple route. And this is the simple route. All right. So IV stays the same on puts. No, IV is going to change on the puts. IV is going to change just like it changes on the calls. And we would have effectively the same overall style trade if we use puts. Once again, this comes back to, do I want to expose myself to the risk of assignment, or do I want to play it easy and not have to deal with that? I'm going to choose easy. Now, any other questions? Everybody understand this, what we're doing, how we're doing it, what we're, what we're doing to make money here? That is the important thing. I want people to walk away from this with a pretty clear idea of how this works and why this works, so that you can take a look at the dozens of different companies coming up and think through it the same way. Now, I'll warn you, this takes practice, and you really should. This is a more advanced trade. This is something we do with, people who've been through the full throttle program, have learned about the Greeks, understand all the aspects of volatility, and that stuff, and practice it a little bit live in the group in the ALTV like we're doing right now. And at the end of it, you're going to be doing these things on your own, picking and choosing the ones that are right, the ones that are wrong, and knowing which ones to go for. I like this one, by the way. This one's nice. I'm looking forward to making some money on this. Could I do a butterfly around 192.50? Yes, you could do a butterfly around 192.50, except for one thing. You are going to be either not using the volatility aspect of things at all in your favor, and that could hurt you, or you're going to be on the wrong side of volatility. Remember, butterflies are a short volatility trade. This is a long volatility trade. It's benefiting by implied volatility going up. What you are likely to see if you set up a butterfly on this is the zone that you're going to be able to make a profit in is probably going to be narrower, or if you build the butterfly wide enough to make it a wider zone, the profit target is going to be lower. What I'm using is the implied volatility change as an advantage. You could use other tactics. There's certainly other ways of doing it. In my opinion, I think this is one of the best tactics you've got around an earnings announcement with an understandable volatility event. That's a great way of using volatility to create an extra edge for you. Because bluntly, I would guess that about high 90% of the market has no clue how this trade works. If we've got a bunch of people who are ignorant of this and we understand it, it gives us an edge and allows us to play with the game, play with a better opportunity in our favor. I like that. It works well for me. This isn't completely unique trade. There are people who do these regularly, but it's typically not your general retail options trader. So, all right. Trade up 1.8% already. Yay! We're a little ways towards that profit target. Awesome. Michael, rule of thumb on this one is if you are targeting up, use calls. If the price of the stock is heading up, use calls. If the stock of the price is heading down, use puts. Nice and simple. If you go with that, it's going to get you your right answer. There's a ton of other ways I can analyze it, things I can show you about why that's right, but just really simple. If the stock is heading up, calls. If the stock is heading down, puts. There you go. Okay, let's touch on some other stuff. I'm going to take a look at one or two other things real fast, and I'm probably going to get the hook coming out at me relatively soon.
I'm warming that hook up, Doug. but you're doing good.
Okay, two promises I made that I want to follow through on. One is, what the heck is this thing down at the bottom? What does it mean? What's this indicator? And inevitably, the question is, how do I get it? Let me explain what that is and why I have it on here. So let me see here, not the hook. Tim, by the way, and this is for everybody on my regular class, as I was coming into this session this morning, I was putting together a full review of every single trade we have, writing up where we stand on it, little notes, all of those things. And I have like 2 more to do, and I'm going to press publish. You guys are going to get a copy of everything. So we're fine as far as I'm concerned on ADSK. We're in good shape on that. Not worried about where we are right now. So I'll send you a full update. But let's take a look at the indicator. As most of you have probably guessed, I like to deal with volatility. It's a huge opportunity. It makes me money. It allows me to do a lot of things in the options market that people don't pay attention to, and I like that. But I have to understand some things about volatility, especially when I'm setting up different trades. And there's a few things that you really want to be able to know whenever you're looking at any symbol. Before I even pick the tactic, I have to know what the environment is and how things are working. And that's what the chart down below is. So this indicator is a combination of some ThinkScript programming I've done, some brilliant ideas by other people, some different thoughts and things pulled together, actually some research out of Chicago Booth School where they do a ton of markets research, all kinds of stuff. And it has 3 main components. One, really, really boring. It's the implied volatility. This is just the aggregate implied volatility that you would see if you looked for IV on any symbol in Thinkorswim. That's all this line is, the solid green line. Second one is historical volatility. Now, this is, I think, going back 200 days or something like that. I'd have to double check the exact range. It's calculating out how the stock actually did move. Now, quick thing to think about, implied volatility is basically telling you how the stock is moving, but it's implied from the price of the options. But it's telling you how quickly the stock is moving around, or how much the options market is pricing in the stock moving around. Historical volatility is how much the stock actually is moving around. These 2 numbers are the same. It's like measuring miles per hour versus miles per hour. And it is essentially 2 views. One is looking at the car going down the road, measuring it, and calculating how fast it's moving and checking it off and putting it on your list. The second is calling up the insurance company saying, this car is driving down this road. How fast do you think they're driving? That's literally what we're dealing with here. Implied volatility is the insurance company's view. Historical volatility is a reality. So I use this a lot. Options prices overprice risk, okay? So we need to be careful. If it's extremely overpriced, I want to make sure that I'm getting some kind of short volatility situation on my trades. I want to get some aspect of my trades that is short IV, and that means that we're doing a lot of really basic, straightforward trades. Vertical spreads, iron condors, a whole slew of your standard bread and butter trades. That's what I want to know. But there are times when implied volatility is very, very low, and it's likely to move up. And I have a very clear pattern of it moving up. Just like that earnings trade we just did. I know that's going to happen. So this helps me understand how that's going to go. Now, that helps me choose the right trade, the right tactic for the right time. So I have a clear plan on that. Now, there's another thing that this shows me also. Every single stock has a natural range for its own implied volatility. And there's a reason for that. There are companies that are risky, and they could blow up, or they could have bad earnings, they could have bad whatever, who knows. But the point is, they have a certain level of risk, and people selling options understand that, and they know that. And they are not going to be stupid and sell an option for a price where they are not covering their own risk. It's a bad idea. It's a quick way for an options floor broker or an options professional to go broke. And they're professionals. If they've survived, they're smart at this. So they don't go below that. What that does is it gives me a nice clear range for implied volatility. And that actually helps me out a lot. Let me just try to find something real quick. I'm scanning here, so all right, kind of boring. I'm not going to go into a trade on this. I just want to point something out. Right now, we have an implied volatility range, which, by the way, is this little dot right here. It's measuring the last 400 days. It's saying it's taking a sample for every single one of those days of implied volatility. And it's telling me right now that only 6% of the samples of the history of Toll Brothers, 400 days worth of history, has been below the implied volatility it's at right now. Which means that this implied volatility for Toll Brothers is at the bottom end of its own range. Now, this gives me a couple of tools. Number one, I know that it's unlikely Toll Brothers' implied volatility was going to drop much more, maybe a little bit more, but it's, you know, imagine an imaginary center point and there's an elastic band stretching out and getting tighter and tighter and tighter, and it's harder and harder for it to go down. It means there's a lot less chance that the IV is going to drop much and a lot more chance that something's going to trigger it and it's going to pop back up. That means a couple of things for me. First of all, that's a bad situation for doing a vertical spread or a short volatility trade, because a pop in implied volatility is going to hurt me, and I'm not, this is another piece that you learn in the full throttle sessions, I'm not getting paid very well to take the risk in that trade. It's just a quick rough estimate of, am I getting paid well to take a risk? Two things. One, implied volatility is really close to historical volatility, which means there's not a lot of premium for the risk you're taking. Number two, it's at the bottom of its range, meaning that implied volatility is not likely to drop anymore, but it could jump and hurt your trade. So when I see that situation, IV low, then I know I avoid vertical spreads. Does not mean I can't take a trade. This is an excellent opportunity for a calendar trade. I'd use a bull call calendar here. Basically a really simple calendar targeting about 2-3 weeks into the future. Find a strike, in fact, almost similar to the trade we just took. Find a strike that is likely that Toll Brothers is going to move through or be very close to near the end of that 3-week period. Short that option. Go out a week or two, and teach you all about that later on. Go out a week or two, buy a long option, and two things. One, I've got a really good high performance trade if the stock moves up. Number two, if implied volatility gets a little bump from any reason whatsoever, heads back up into its normal range, that implied volatility makes that trade go wild, and I make a bunch of money. Extra bonus is when and if the Toll Brothers starts to drop, what's going to happen? Implied volatility goes up. Directionally, I'm losing on the trade, but IV volatility-wise, I'm winning on the trade. The two offset each other, make it easier to control, reduce my risks, increases my chance of making money. So that is just a couple of ways that I use this indicator. It is linked up on every Thursday when I do a class. I also post the video recording. I post links in that recording to download this indicator. Anybody who's part of my program is welcome to download it, load it up, and every time I update it or tweak it a little bit, you get a new copy. So that is what that indicator is. Last promise I had, VXX, and I'm going to do this fast because I know Wiz is going to yank me here. All right. Risks. What about a put calendar with so much short-term market risk? Sure, you could do that, but once again, you're calling tops and bottoms, Dave. There's nothing wrong with that, but you better have a good reason why you believe that put calendar is going to work. And there are plenty of symbols out there where you do have a good reason why that put calendar can work. Find a good, clear symbol trending down with low IV, and they're out there right now, and set up a nice bear put calendar, basically setting up a calendar with strikes underneath the current price that you expect the stock to move down towards and through. 2-3 weeks out in the future, use a short. Another week or two past that, use a long, and you're setting yourself up for a great potential trade. I love bear put calendars. Hard to find a good example of when to use them. They're a little more rare. What you don't want to be doing is calling the top, because that is a fool's game. You are going to be beating yourself against the market all day long. The market's been going up for a darn long time, and it's likely to continue to go up further. If you pick out this as a top and you're wrong, you just continuously lose. This trade run I'm about to show you is what I do instead of doing that. So we have a problem in the market right now. I have a whole list of things that I don't like about this market. But guess what? The market's going up, and I'm going to trade what we have. I need to protect myself against what might happen. And I also need to clear my head out. Because actually, I'm going to make a point. Dave, you're saying, what about a put calendar with so much short-term market risk? Good point. What I see right there is something that's actually a bit of a problem, though. And I'm just using you as an example. Don't take this personally. When traders get fixated on what might happen if the market crashes, it causes you to not take good trades. Fear and uncertainty about upcoming market conditions without having a solid basis of why and when it's going to happen is a trading cost. It erodes your profits, it reduces your profitability, it doesn't make you have as good results. We need to figure out a way to get rid of that so that we can focus on the trades that are going to make us money and do them confidently without taking, without letting that risk kill us. So all of that aside, this is what I do. VXX, and people will say, why don't I use SPY? Why don't I use IWM? Come to my class, I'll give you a full in-depth explanation of why SPY, IWM, diamonds, whatever, or SPX are not as good in this. VXX is the tool I use. I'm going to go out, usually about 60 days, couple months. I am going to, in this case, I'm going to use November 17th, and I am going to do a bull call calendar. This is debit spread, and it is way out of the money. Now, in this case, all right, if the market were to do a true correction, crash, talking 7, 8, 9%. No matter what I do in my trades, whatever stop losses and things like that, I'm going to be dealing with a bloodbath in my portfolio. And it's going to be painful. I can't make good trades now while also protecting myself against, hypothetical chaos situations unless I do a separate trade like this. So in this case, this is a VXX hedge I actually have on right now. I'm going to go a little bit lower than this. In this case, I'm going to use a 70 strike on VXX, which is less than twice as much as this. I'm going to do this quick. I'm going to go long on the 70 strike. And that's going to cost me 81 cents. I could just leave a long 70 strike call. But honestly, theta erosion is against me, bunch of things, overpriced, all kinds of reasons why this trade is not particularly good by itself. And it's expensive. Trick to this, I go out about $3, I get a short. Instead of 81 cents, I now can do this for 11 cents. Cheap, very, very, very cheap. So let's take a look at this thing. If it cost me 11 cents to get into this, and I have a $3 spread, I'm gonna run some numbers. My max profit on this is $3 minus the cost of getting in, 11 cents, $2.89. Now, what is my return on investment on that if I actually made 100%? Divide by 11, I am making a 2,627% return on investment on this. Now, let's get some reality in this thing. In what case would I actually make money on this? The only way that VXX is going to shoot up that high. And in fact, I would probably move this down, go for a slightly more expensive trade, but closer to the current price of the market. My guess is probably around 65, 66, somewhere in that area. The only way that this trade is going to work is if the market crashes. VXX is going to follow VIX. VXX will just about double. It'll go from 40 to about 80, and boom, I'm going to have a bunch of money in my pocket. I'm not going to make every single cent out of that. So I'm going to buffer this, put a little reality, and say times 0.8. So my reality is I am making 2,100% on this trade. If I want to protect myself for $5,000, $10,000, whatever, what do I think my portfolio is going to lose if the market crashes? Well, I've got a leverage factor in here, 21 to 1. So for every $1 I put in, I have the potential of making $21 out of this. If I want to protect $10,000, I divide that by 21. I spend 476 bucks. So if I figure out this is $11 each, I want to buy 43 of these, probably rounded down to 40. If I put that on for the next 60 days-ish, I have an insurance policy. If the market crashes, I'm going to be able to walk away with this trade with about $10,000 worth of profit for spending 480 bucks. So it's an insurance policy. And by the way, I expect this trade to lose. I want this trade to lose because that means that the rest of my portfolio is doing what it's supposed to. It is an insurance policy. Do any of you really want to come out ahead on your health insurance? It means you're probably going through some pretty nasty, procedures that are no fun and not pleasant in any way. This trade is the exact same thing. I do not want to win on this trade. What I want is to create protection in my portfolio to protect me in case something really crazy that I cannot control and bad happens. And it just sits there. And honestly, it'll probably erode down to zero and I'll put another one on later on. But what this does is it gives me an advantage in a different area. I can stop, because this trade is on, and I know it's on, I can stop thinking about what if the market crashes. And I can start taking trades that are good based on the information I have in front of me right now without speculating on what'll happen, could it happen, when's it going to happen, all of those things that stop you from making good trading decisions. And my goal in this portfolio is that over these 2 months, 60 days, when this hedge is on, is to make smarter trades and better trades because this hedge is on than that $480 that it cost me. So I pay for this hedge by making better and smarter trades and focusing on what the market's doing. And that right there is a simple, easy way to basically hedge off your portfolio. A ton of other ways we can do it. Lots of good ideas, balanced portfolios, things like that. But that one right there is quick, simple, and cheap. Now, how do I use this thing? Once it's on, we forget about it. It's not part of our P&L. We don't, well, you want to count it on your P&L, but focus on other things. When the market crashes, first thing we focus on is risks. Take and close every single trade that you have that is risky, that is giving you pain, that's losing money. And there's going to be a lot of them. So work through those. Get all the risk off your books. Second, take a look at all the trades that possibly benefited from the market crash, your bearish trades, your long volatility trades. Figure out, should I take a profit? Shouldn't I take a profit? Get those taken care of. And at this point, you should either have no trades in your portfolio or just a handful of trades that are so rock solid that you don't care about them one way or another. Turn around and you close this trade for a very significant profit, probably making somewhere between $8,000 to $10,000 on this, depending. And by the way, I'm running through this kind of fast, so we probably want to get a little more detailed on that. But then you close this trade, that profit offsets the losses you got in all the other areas. Are you going to walk away from this market, this situation, not losing anything? No, you're probably going to lose a little bit, but you're going to be the guy walking away with a 2% loss, and all your buddies are going to be walking away with a 15% loss. I'll take the 2% over the 15 any day. So that right there is a quick and simple rundown of a straightforward VXX hedge. Now, there's a lot of things that I know I'd get for questions, like VXX erodes over time. Absolutely. It's actually kind of built into the options prices already. Well understood phenomenon. Could I do this on SPY? Could I do this on SPX? Could I do this on this? Yes, but all of those actually have individual problems that don't make it work as well as VXX. Could I do this on UVXY? Could I do this on any of the other volatility symbols? Yes, but pick one that has very, very good volume and lots of liquidity on the options. So quick rundown, that is the VXX hedge. Now I can feel the hook coming. So Wiz, all of you. You out there? Buy when vol is cheap, sell when it's high. Yes. Now there's tons of trades you can do around volatility. Wiz does them all the time. I think you did a double vert or something like that, or set up a really nice little
bullish double vertical the other day.
See, that's a trade, and that's a great idea when you've got the opportunity for a trade. You do that. This is not a trade. This is insurance. Two totally different things. I would have both of those trades on at the same time. But all right, I'll tell you what. Anybody final questions? The $10,000 is based on the max risk of my portfolio positions. Yes, this is what I would do if I were in your case, and this is what I do for my case. is I run through a little scenario that says, if the market were to crash and I'm looking at my portfolio, what would happen to this thing? How much pain would I have? How much blood would I have on my hands? And I will run through a little scenario. I'll go back in time, take a look at a couple of corrections, and just kind of equate it to this market now and see where I'd be. I'm assuming that I'm not going to be stupid and I'm not going to be, on vacation in Fiji and not near my computer, but I want to find out what the pain is. And I find out what that number is, assume that I'm going to take that as a loss, and I use that as the basis for figuring out my hedge. Now, do I want to hedge every bit of it? Insurance is expensive? Probably not. But I want to hedge off a good chunk of it. I figure out, I make a decision. How much do I want to hedge off? Once I've got that number, I just divide it by my leverage factor, and I know how much money I have to spend on the hedge. It gives me a nice little insurance policy. Will I roll near expiration or let it expire? Well, I would just let this expire, but I'd also be putting on a new one. I wouldn't call it a roll. I'd just create a new trade, but yes. All right, sorry, Wiz, I didn't mean to cut you off, but I know that you had some VXX trades out there. I'm going to hand it over.
You got it, man. Awesome, folks. Let's all give Doug a virtual golf clap there for his work last night and today. So nice job, Doug. Somebody asked where you can see all the replays. Let me just cover all the administrative items here. Doug will he's going to type up the replay and all that stuff just like you would with normal members, and then he'll make that post public, kind of like I did the other day, and then he'll send out, we call it from our broadcaster, a link so even non-members can view the member content from his advanced live trade brief today. So everybody give Doug a virtual round of applause. If you have any questions about what Doug did, he and I are going to jump on a webinar tomorrow afternoon at 1 o'clock. We'll debrief for about 30 minutes, any questions you have from any of our trades from the week, and then I'm going to do our weekly options live trade brief. So there's the link to the replay page. It's pretty easy. It'll probably take me, I don't know, about an hour or 30 minutes to an hour to render this video right here, and it's going to end up on this page. So we already have last night's training posted right here, his vertical spread training. There's my accelerated retirement. And the trade Doug was talking about, the VXX bullish double vertical. And then we have our Apple. We'll talk about Apple tomorrow, folks. This is, let me pull this up here. Let me see if you guys can see my screen, right? Where is it? Apple stock slump continues, tests a key technical support level. This is one of the reasons I didn't eject yet, is because it's right at that technical support level where I put on my bull put spread. So this is one of those lucky strike moments, folks. I went into detail last night covering why I kind of flew past my eject level, and like I told you last night, every Navy flight manual has a first page that says, hey, nothing in this book takes the place of good head work and judgment. So I'll talk about this tomorrow. We might even leg into an iron condor on Apple here. So we're good to go. Yep, look at that. A lot of good golf claps there for Doug. Folks, I lost count. I'm pretty sure we're way past halfway through our 50 slots. Somebody asked about a potential monthly or quarterly subscription. You can email support if you're interested in that. If we fill up our 50 annual slots, we're not going to open any monthly or quarterly subscriptions, folks. So we might put you in a holding pattern, kind of sitting over Chicago O'Hare if we don't fill all of our annuals, which we usually do, but we'll see by tomorrow. So there is the page. One more time, let's go through all this stuff since I saw a couple questions. The defensive track. You get the 8 training sessions that Doug's going to give you. Last night, you got a great demonstration of that. And then everything we do here at Talkman Options, except weekly options. That's why we call it defensive. You get that AR, that accelerated retirement brief with me every Wednesday at 1 o'clock. The offensive is everything defensive. Instead of the accelerated retirement, you get to trade the weekly options portfolio. So that's the difference between the two. Defensive, you get AR. Offensive, you get weekly options, and then obviously the Reese's Peanut Butter Cup. The best value, the best thing is everything we do here, plus weekly options and accelerated retirement. Okay, sound of one hand clap for the sensei, exactly. And if you want to know what the sessions are, folks, are on this page. There's all Doug's sessions here. We're probably Doug will throw in a new session 3 here since E-Trade Options House are imploding and a little bit of a train wreck. Personally, he'll find some good content to throw in here. But trading methodology, tools, understanding the Greeks, spreads, condors, calendars, vol, exits, adjustments, everything here, folks. This is normally $495. And like I told you at the beginning of this presentation, as long as you're a member here in good standing, you get access to every time, all of this training, every time Doug does a new one of these. So, I mean, geez, we have members here 5, 6, 7 years that they've more than paid for their annual subscription just by attending Doug's training each time. Okay, and yeah, I mean, somebody posted to me earlier about the weekly options bear call spread I sent out. I think it's up about $1,500, about a 75% gain. I'd be out of that thing. The market tends to sell off into the close on a Friday. If you want to hold it until tomorrow, hey man, you're the pilot in command of your own airplane. So you signed for your jet. But all right, guys, I'll tell you what, I'm going to get going so I can start rendering this video and get it out to you. Like I said, we're well past halfway through our 50 annual slots. If you have any questions, concerns, oh, by the ways, you can give us a call at 754-300-1084, or you can always shoot an email to support@topgunoptions.com. Okay, I'm going to shoot my daily sit rep here in a couple minutes, so make sure you keep an eye on your inbox for that. And then Doug will get you his recap email, not only to his members, but to all the potential new Full Throttle members as well. Okay, have a great rest of your day. Happy hunting. Make sure you hedge. And Doug and I will see you tomorrow at 1 o'clock for our Full Throttle debrief. We'll see you.